Welcome back. Today we're going to talk about the time period principle. This is a principle that requires the definition and use of the same period of time for the accounting period. That means that when a business, when it first starts, decides on an accounting period that they want to use, they have to stick with that accounting period for the life of the business, unless there are special circumstances. So if they choose 1 month, then every accounting period will be 1 month. They could choose every 2 months. They could choose every 3 months, every 4 months, every 6 months, or every year. But generally most companies choose 1 month. It's important that this accounting period is consistent so that you can do proper decisions, proper comparisons from one period to another. Each business decides on what kind of accounting period they will use. This allows the owners and the managers and the investors and the government and other people to compare one accounting period to the previous accounting periods. Another important principle is the matching principle. The matching principle states that expenses should be recorded and matched with the revenue they help to generate during the same accounting period. It's important that you note that the word match is very important. This is called the matching principle. We are matching expenses to revenues, and we have to make sure that the revenues that are generated are matched with the expenses that are incurred during that same accounting period. When you determine the net income, only revenue earned during that period and only expenses incurred are considered in order to generate net income or net loss. Expenses are recorded when the cost is incurred. So if you have an expense, even if you don't pay cash for it, the moment you receive the invoice, that is the date that you use in order to record your expenses. When you receive that bill, that's the evidence that the expense was incurred, and that's when it should be recorded. Let's take a look at what happens if you don't follow the matching principle. In this example, please notice the top section is done properly. Watch while I make some marks on here. Notice that for June, we have $1,000 net income, and for July, $1,000 net income. In this example, we want to show what happens if somebody takes $2,000 that should have properly been included in June, and instead they delay. Say they delay because they paid the bill in July. So they think, well, if I paid it in July, I should record it in July. And so here's what happens. This $4,000 that you see up here that is correct was reduced to $2,000 because they did it incorrectly. So that $2,000 that they took from June is now added on to the $5,000 that was originally there to make it now $7,000 in July in the incorrect section. Now take a look at what happens when you incorrectly put amounts in the wrong accounting period. For the month of June, there's a $3,000 net income. But now look, because of that $2,000 mistake, you now have a $1,000 loss, as noted by these parentheses. It looks like the business had a very good June and a bad July, but in reality, we know that the proper answer is up here, and we actually had a pretty even June and a pretty even July. So that's why it's really important to make sure that you match your revenue and expenses in the same accounting period. Next thing we have to talk about is the accrual basis of accounting. The accrual basis of accounting matches revenue earned with expenses incurred to produce the revenue during the accounting period. Well, this sounds very similar to the matching principle. And in fact, the way I like to tell students is to think of it as the accrual basis of accounting follows the matching principle. And so that's why their definitions are so similar. It produces an accurate picture of profitability for an accounting period. When we record revenue, we recognize it as it is earned, even if cash hasn't been received. If you have a customer who uses your goods or services and they say, "I'll pay you later," the moment that they receive the goods or services, that's the moment that you have to recognize that revenue has been earned. For expenses, they are recorded as they are incurred. They're recorded whether they're paid by cash or there is a promise to pay at a later date, which we call paying on credit. There is another basis of accounting that we need to study. It's called the cash basis of accounting, and it recognizes revenue and expenses when cash is actually received for revenue or when cash is paid for an expense. It has nothing to do with when the bills are received. It only has to do as when cash is either taken in or given out. It's recorded only when cash is received for sales or other revenue, and expenses are only recorded when cash is paid for an expense. The cash basis of accounting does not compare revenue and expenses for the same accounting period, and that's its drawback. And it does not conform to the matching principle. Furthermore, it's not used in real life by accountants for businesses, but we need to know that it exists. Your assignment for today is to discuss case studies 1 and 2, and we did that in class, so you're going to have to read it on your own, and then if you have any problems with it, come and see me. Your assignment for today is to complete questions 8 to 12 on the blog, complete exercises 4 to 7 from the textbook, and you will put those answers in your workbook, and then complete case study, which is also on the blog.